Well, ladies and gentlemen, welcome to the 36 commercial webinar on cryptocurrency and taxation. My name is Michael Patrick Joyce. I'm a member of 36 Commercial, and I'm joined by my colleague, Ben Simons, who is also obviously a member of 36 Commercial. My practice covers commercial litigation and arbitration, both here and abroad, particularly but not exclusively in the Gulf as far as foreign jurisdictions are concerned. But for over 20 years, I've included VAT and other indirect taxation as part of my practice, both here and in the Gulf, where, of course, the UAE and Saudi Arabia and Bahrain have all adopted a VAT, with the other countries in the GCC countries following suit. Ben is our expert on direct tax, so focusing on income tax and corporation tax. He's also the author of Cryptocurrency and Blockchain, which was published in February of last year. It's a Bloomsbury Professional Tax Insight publication. We think, but we don't lay total claim to this, that it's the only book on crypto tax. It's certainly one of the very few books on crypto tax. And of course, in my wholly objective perspective, it is the best book on crypto tax. So that introduces us. I've got a few housekeeping matters to deal with. As I mentioned informally before the recording formally started, this webinar is being recorded. If you wish to take notes, obviously, you're very welcome to do so, but there'll be no need to do so, because what we will be doing is distributing a handout which we'll provide after the webinar. And the third element of housekeeping, and it may of course have something to do with the notes that you take, please do ask questions during the course of the webinar. There is a Q&A button. Please use the Q&A button perhaps rather than the chat button. We will monitor that as we go. We do look forward very much to your questions. The whole purpose of a webinar is to create an iterative environment where you are as much a part of it as we are. So, having said that by way of general introduction, we're going to start the substance of today's webinar with Ben giving an overview of the history of Bitcoin and why we hear so much about cryptocurrency in the media, really on an ongoing front page basis. I'll then talk a little bit about something called Vatcoin and the role of cryptography in tax administration. So moving to look at the indirect tax side of the balance. Ben will then run through the tax treatment for individuals trading cryptocurrency, and also talk about contentious tax issues relating to non-domiciled individuals. He'll give an overview of offshore structures which can be put in place to minimize tax for corporate clients. And then I'll wrap up the webinar with what I really think is perhaps a little bit of an outlier subject, but quite an interesting outlier subject, and that is to bring in another topical news item, which is NFTs and non-fungible tokens, and look at the implications that they may have because of the smart contracts involved for things like artist resale rights. And then we'll have questions and answers. And as I say, I hope very much that questions will come in during the course of the webinar. So, Ben, I've already said that you're going to provide a brief history of Bitcoin. May I invite you to do so?
Thanks, Michael. Yeah, Bitcoin was created by the anonymous cryptographer Satoshi Nakamoto, who mined the Genesis block on 3 January 2009. Bitcoin is a decentralized online currency It uses blockchain technology, which in turn uses cryptography to secure integrity of the ledger. This is where we get the expression cryptocurrency from. It is the fact that it uses cryptography to secure the ledger. That is how cryptocurrency derives its name. In its early days in 2009, 2010, it was traded by cryptographic fans trading amongst themselves. And then in 2013, it came to widespread public attention for all the wrong reasons. The FBI shut down the notorious drug trafficking syndicate Silk Road. And as part of their investigation, it came to light that members of that syndicate were using Bitcoin to pay one another. Excuse me. Presumably, they thought that they would remain anonymous if they were transacting with Bitcoin, and it wouldn't lay a paper trail, so to speak, for what they were doing. In fact, they were mistaken. Bitcoin is pseudo-anonymous. If you have somebody's public key, you can go to the Bitcoin blockchain, and that contains an indelible list of transactions of that individual has entered into. So the members of that syndicate were mistaken in thinking that Bitcoin would cloak their identity. As a result of the FBI's investigation, that triggered a congressional inquiry into cryptocurrency. And in November 2013, Ben Bernanke, who was then chairman of the US Federal Reserve, wrote a letter to the congressional committee. And in that letter, he expressed cautious optimism about the possibility that blockchain technologies / cryptocurrency could offer an alternative to the current traditional banking model. And this spawned an industry of startups in London, San Francisco, and elsewhere, intent on disrupting the current traditional banking model.
Well, Ben, you've spoken about the notoriety, and that's obviously one reason for it being in the news. You've spoken about Ben Bernanke's views as to how it could possibly offer. He was talking about the cautious optimism that you mentioned. Why do we hear so much about cryptocurrency in the news? It just seems to get a louder and louder volume in the news. Tell us a bit more about that.
Yeah, well, the first reason, Michael, was that cryptocurrency offered an alternative to the current banking system. Essentially, when you go into a shop to pay for goods or services, you know that the correct amount of money will be debited from your card, and the merchant knows that they will get paid because there is a chain of trusted financial intermediaries that sit between yourself and the merchants. The problem with these financial intermediaries is that they levy very high fees. For foreign exchange transactions, it can be up to 20% of the transaction, to 20% of the amount of the transaction. Cryptocurrencies using blockchain technology offer an alternative to this model. They are decentralized, they don't require financial intermediaries, and they secure the ledger through the use of cryptography. Doing away with the need for financial intermediaries means lower transaction costs, or hopefully no transaction costs. And that is very attractive. It means the merchant keeps more profit for themselves. It means more keenly priced goods and services. And that is very attractive from a consumer point of view. That is what originally drove interest in cryptocurrencies. The problem is that it's been very difficult to commercialize cryptocurrency as a payment service at scale. Bitcoin processes 4.6 transactions per second. The Visa network processes 1,700 transactions per second. No cryptocurrency company has succeeded in coming up with a payment service that can match the speed and efficiency of the major banks or credit card providers. Facebook probably had the best shot at doing this, but their project is stalled. Their project was originally called Libra. It's now called Diem. They failed to secure regulatory licenses for their payment service in Switzerland last month, and they've returned to the US. It remains to be seen whether they'll get their project off the ground. Why we're hearing so much in the current media about cryptocurrency is because it's become an investment medium. There are rising concerns about inflation, and cryptocurrency is now seen as a safe haven asset. in the last 3 months of last year, the volume that flowed into cryptocurrency increased sixfold. Now more than $2 trillion is held in cryptocurrency, and it is seen as an investment medium. Financial planners are now suggesting that their clients hold a small amount of cryptocurrency as part of their portfolio, and they're using it as a hedge against inflation. It looks like cryptocurrency will go mainstream on this basis. It's not totally clear, but it looks like it will go mainstream on that basis. There are a lot of problems. It is a bit of a wild west. The market is largely unregulated. American billionaire and entrepreneur Mark Cuban lost a lot of money last month. He invested in a stable coin that fell from $64 to zero, and that was because there was a flaw in the token's design. It allowed people to frequently buy and sell that coin. There was some sort of arbitrage opportunity, and they arbitraged the value down to zero. And he was an experienced investor. He lost a lot of money. There are a lot of crypto scams, and there are also wild swings in the value of cryptocurrency. Forbes magazine estimates that the world's top 100 cryptocurrencies last month lost 40% of their value. So it looks like it's going mainstream as an investment medium. There's still some uncertainty, and it'll be interesting to see how that plays out. Yeah. So I've been talking a lot about why we hear so much about cryptocurrency, but I'm going to hand over to Michael. Michael, can you tell us a bit more about what you'll be discussing on this webinar?
Yes, absolutely. And before I launch into what I'm about to say, I just thought it was very interesting how in a relatively short period of time, something that started off as really anti-establishment from libertarian and anarchic origins is now being spoken of as becoming mainstream. And I think that really encapsulates the significant distance that's been traveled already. But what I wanted to talk about first was really to balance the equation, because in one sense, taxing crypto assets is only one aspect of the equation, because there's also the application of cryptography to tax, and here I'm particularly thinking of tax administration. And thinking about that a little bit further, I think there are two, possibly three, related but distinct aspects to have regard to. And the first is really how crypto technology, how crypto techniques, and here I have in mind, obviously, blockchain, smart contracts, AI, data analytics, etc., how all of that technology can benefit tax authorities. But then again, there's a flip side of that coin as well, because how do such techniques and technology benefit either individual taxpayers or perhaps more realistically, for reasons I'll come on to, taxpayers collectively? And then that's a little bit of blue skies thinking, but bringing it sort of back to ground, back to present day reality, and indeed something which might have been of considerable help over the last couple of decades, using the new AI cryptographic techniques to counter tax fraud. And here, because it's well rooted within indirect tax, which is my area, I'll take a look at that by reference to what used to be called MTIC, or missing trader intra-community fraud, or carousel fraud, and use that as an example.
Yeah, thanks for that outline, Michael. Do you want to take us through each of those in turn?
Yeah, I'm very happy to do that, Ben. The first aspect is, if you like, a deep dive into deep learning. Deep learning obviously being a term of science related to machine learning models, and in particular, the deep learning that is acquired through neural networks of artificial intelligence. And using these neural networks and artificial intelligence to detect patterns in data sets. And the obvious data set here is going to be tax returns. There's an enormous amount of information which is really hidden in tax returns. But the big challenge has been accessing it. And the big issue hitherto has really been very clear. It's been individual privacy and confidentiality of tax records, because a tax authority is, let's face it, unlikely to have the resources for state-of-the-art, elaborate AI facilities in-house. But nor can a tax authority simply subcontract the analysis of labeled, i.e. taxpayer identified data, to an external provider. So a lot of information there, but how do you access it? Because if they did what I've just suggested, which seemed to be the only practical alternative until very recently, you would of course have all sorts of GDPR, data protection, human rights, privacy concerns. Now, with the rapid development in AI and the deep learning to which I've referred to, and the artificial neural networks with further developments, convolutional neural networks, neuromorphic computing in general, it's possible to take unlabeled, i.e. anonymous or anonymized data, which would previously have needed to be labeled. Well, you think, well, okay, this is great from the tax authority's point of view. It makes administration much smoother. But here's the thing. Have we, or if we go down that route, will we simply replace one problem with another problem? And I think if we look at this in a little bit more detail, from a lawyer's perspective, the replacement is actually rather interesting. Let me say more. It comes down to a concept known as explainability. Now, that's fairly obvious what it means, but just to add a little bit of flesh to that, neural networks work on an iterative process, and the machine learning learns itself through analysis of the data that it's fed. So there's a sort of black box sitting there. And it's perfectly possible, and let's assume that the black box provides the right answer. But of course, it's not sufficient to provide the right answer. You've got to be able to explain how you get to the right answer. And what happens if a taxable person challenges that it's the right answer? How do you satisfy a court? And of course, it's not just a court, it's a judge who might not be too tech savvy. How do you satisfy that judge that that's the right answer? So I think there are going to be all sorts of issues to the deployment and use of artificial intelligence. And indeed, you may put it the other way around. You may say, well, if it's inexplicable, then is the starting point, well, that it can't be proved to be right, so it isn't right. So we must assume it's wrong, unless proved otherwise. Is there a burden, therefore, on the tax authority? And how can a tax authority discharge that burden? Now, I think this is going to be an absolutely fantastic argument, and it's an argument which is coming down the tracks. But of course, it doesn't even stop there, because what I've assumed so far is that the data set is accurate, i.e. that it's free from bias. But we know that data sets are not necessarily bias free, and you can carry over human unconscious bias into machine learning unconscious bias. And let me give you just one example from human resources. If you are advertising for a job vacancy, and the job vacancy is of a position which has historically within the firm always been filled by white males aged between 30 and 40, then if you feed all of that historic data into the machine, it will sift and look for white males in their 30s. But that is a bias born of history, and they may have been the best people for the job then. But it means that you have to guard against bias creeping in to data sets being used in any artificial intelligence environment. So it seems to me that there's an inevitable, an inexorable, unstoppable movement to using AI. It's cheaper, it's cost effective, you probably save on the number of tax inspectors, etc. And it provides greater focus, because if you're doing it right, you're focusing in on the areas of difficulty. Fantastic. But the quid pro quo is that there is a corresponding risk, not just in terms of explainability and validity, but also a really, really strong concern, if you are a taxable person, that you may be the unwitting victim of unconscious machine-learned bias. So those are the areas that I'm interested in terms of using AI for the benefit of the tax administration.
Thanks, Michael. And I think there are a couple of other aspects you wanted to cover as well.
Yeah, absolutely. The second aspect is to look at it from the perspective of the taxable person, of the taxpayer. Now, I think here it's probably better to look at it collectively rather than individually, because I can't think of well, the number of natural persons who would be able to employ sophisticated AI for their tax return would be very limited indeed, and probably it's only in the realms of the biggest corporates who might be looking at that on a standalone basis. But here, what I was putting together in my mind was two things. One is the Laffer curve, in terms of where does the optimal taxation point arise, and that's doubtless well known to many of the audience. But also there's a much more recent idea of legal singularity. And legal singularity essentially is, as we use artificial intelligence, so one can narrow the aberrant, wrong decisions and get to a jurisprudence which is much closer to the absolute. You're never going to get there. You're never going to get just one answer, which is what underpins the word singularity. But that's the move that's the direction that we're moving in. So there's this increased convergence on, therefore, in this context, what is good, i.e., efficient, in terms of a tax system. And putting those two things together, if you have convergence and apply it to the Laffer curve, then what started off as an academic and rather theoretical concept of, well, if you tax at 100%, you get a very small tax take. If you tax at naught, you get again, a no tax take. You've got to get the taxation somewhere in that middle bracket. By applying AI and the concepts of convergence and singularity to that, then you should be able to pinpoint much more clearly where the optimal tax is. And in terms of looking at it from the other side of the coin, for the benefit of taxpayers collectively, if you can be more precise about what is the optimal tax system, then it seems to me that it's a benefit for everybody.
Yeah, thanks, Michael. What you've said involves a lot of futurology, and I think the third aspect of what you're going to talk about relates to the here and now. How might blockchain and crypto assets counter tax fraud?
Well, yes, this brings it back to, as you say, current day and indeed recent past history. But one of the attributes of crypto assets is that an attribute of tokenization in general is that the token has a representational quality, represents an underlying asset. And being more specific, we're all familiar with cryptocurrencies, Bitcoin, Ethereum, matters that you've already touched on, Ben. And also with stable coins, which are cryptocurrencies, but usually collateralized with a view to making the cryptocurrency in question more stable against the volatility of the likes of Bitcoin. And although you can collateralize against many assets, the obvious asset, at least in the present context, would be to collateralize against a fiat currency, which in this country is pound sterling. Now, that's all by way of introduction, because the essential question in this aspect seems to me, why not use a collateralized specific cryptocurrency as part of the accounting exercise at each stage of the production and distribution chains for the purpose of accounting for VAT. And I'll come on and explain this, but I should immediately say, and give credit where credit's due, that this isn't my idea. It's that of an academic, Richard Ainsworth, and an entrepreneur, Mike Cheetham, and colleagues of theirs. And they've come up with this notion of VAT coin, which would be a stable coin collateralized against pound sterling for the specific purpose of VAT accounting and the exercise by each and every taxable person of the right of deduction, netting off their input VAT against the output and accounting to HMRC for the difference. Now, as Ainsworth and colleagues have pointed out in their papers, VAT coin couldn't be a standalone. It would have to depend on an anterior change, and that is the adoption of digital invoices. In this regard, the UK has been a bit of an early mover because it implemented Making Tax Digital in 2015 and has rolled that out progressively. Now, that hasn't reached the stage of complete digitalization of invoicing and sale of goods. That has actually been pioneered in South Korea. So that points the direction of travel. And indeed, South Korea probably points to the destination. But if invoices became digital, then that invoice could be written with two components, as indeed it is now, price of the goods and the VAT chargeable on the goods. But in VAT coin, you would charge the price of the good, net of tax in pound sterling, and you would apply the tax in VAT coin equivalent to the pound sterling 20% on the price of the good. So the VAT coin would sit there in the production and distribution chains of manufacture and supply as a digital representation of fiat currency. And it would remain so until you reached the tax point where either you accounted for the net tax after exercising the right of deduction, or I suppose if you were a repayment trader, getting the money back. But it would only be at that point that the digital representation would be converted from stablecoin into fiat currency. And during every other stage, the VAT coin would have a representational value representing the tax, but within the supply chain, not outside. And at the tax point, the value, as I say, would be paid, or you'd receive a repayment if you were a repayment trader. But the essence of VAT fraud, missing trader fraud, is essentially acquisition fraud at the top of the supply chain in the particular jurisdiction in question. But if you replace the VAT with VAT coin, a missing trader wouldn't go missing with pound sterling, but would go missing with VAT coin. And VAT coin would have no value outside of the confines of the trading environment in question. Now, it is susceptible of a much more detailed explanation, and that's all set out in Richard Ainsworth's papers. That essentially is the idea put forward by Ainsworth and Cheetham and their colleagues. Now, it seems to me that could offer, and I know the EU has looked at this in some detail, could offer an elegant solution to a pervasive problem. But what it also does is encapsulate some of the really interesting thinking that can now be undertaken at the interface of cryptography and taxation. So that covers the 3 points that I was planning to cover in my intervention at this point. And then we know that you're going to go on to talk about individuals trading cryptocurrency, so back to the taxing crypto aspect of the equation. Ben, over to you on that.
Thanks, Michael. Essentially, there are three possibilities for the taxation of an individual buying and selling cryptocurrency. The first is that gains and losses are gambling gains or losses. Every individual who makes a gain would like to say it's a gambling gain because gambling gains are tax-free. As we'll see in a minute, this isn't really a feasible argument. The second possibility is that gains and losses are trading gains and losses. For professional traders in the markets, this will be the case that they're making trading gains and losses. For most individuals, and particularly for individuals trading part-time and at the weekend, they will not be making trading gains or losses. Most individuals will be subject to the third treatment, which is they will be making capital gains and losses. Capital gains are subject to tax at 20%, and the gains and the losses need to be calculated according to the capital gains tax pooling rules. They're quite complicated. There are different rules for same-day transactions, transactions taking place where the purchase and sale takes place within 30 days of one another, and all other transactions. They can be difficult to apply to cryptocurrency, but you've got to do the best you can to muddle your way through those rules. Capital losses can be carried forward for up to 4 years. Most individuals who make a loss would prefer to say it's a trading loss because they're typically more easy to utilize. Realistically, for most individuals, they will be realizing a capital loss. A little bit more in relation to gambling gains. Factually, or in relation to all matters, the taxpayer bears the onus of proof. But factually, it's very difficult for a taxpayer to prove that they made a gambling gain or loss. The taxpayer would have to trade almost blindly for tax law purposes to make a gambling gain or loss. Cryptocurrency markets are more sophisticated than they were 4 or 5 years ago. There are crypto broker research reports. If you have a look online, there are people discussing different trading strategies. There have been arbitrage strategies that sometimes are effective. There are pairs trading strategies. Some strategies are scientific, some are scientific, some are not. But whatever the case, you have to trade almost blindly to be realizing a gambling gain from a factual point of view. Even if you succeeded in factually showing you were gambling, from a legal point of view, it's a very difficult argument. The only authority we have comes from share trading cases, and there isn't actually a single case where the taxpayer has won with the argument that their gains should be tax-free because they were gambling. There are a couple of obiter statements, in a couple of cases, the authority is not strong in this area. And even if you were successful arguing that there is such a thing as a gambling gain or loss for tax law purposes, you'd be caught by the capital gains tax legislation. Section 51(1) of the Taxation of Chargeable Gains Act does not apply to gains realised in trading shares or cryptocurrency. I go into a lot more detail about these arguments in my book that's out through Bloomsbury Professional. In relation to trading gains or losses, professional investors will be realising trading gains or losses, and professional investors are really hedge funds, people trading in the markets. Most individuals will not be realising trading gains or losses. Essentially, there are 4 things that you need to show to demonstrate that you've realised a trading gain or loss. First, you need to be doing the activity on a full-time basis. Second, you need a strategy and you need to execute against that strategy. It doesn't necessarily have to be that scientific, but you need some sort of a strategy. Third, you need to do some basic bookkeeping. And fourth, you need a business plan, ideally a written business plan. Probably the most interesting recent example of a taxpayer who was found to be trading was the case of Allian HMRC in 2016. Mr. Ali ran a successful pharmacy business, and he got someone in to run his pharmacy business. He moved into an office upstairs and he traded shares full time. He executed about 30 to 40 transactions a day. He had a very basic strategy where he read broker research reports, and he based his trades around those research reports. He realised losses of around £1 million over 4 years, and he later sought to utilise them as trading losses, and HMRC disputed this. At the tribunal was probably a bit sympathetic to him. He got through by the skin of his teeth. He was very lucky. He could show he was doing the activity on a full-time basis. He had a basic strategy relying on broker research reports, probably not that scientific, but it was enough. He did some basic bookkeeping, and he articulated an oral business plan at the tribunal. Really, the tribunal were a bit sympathetic to him. He got through by the skin of his teeth. And the other thing I should point out is that different tribunal judges can reach different conclusions, even based on the same facts. They have a wide margin of discretion as to whether an activity is trading or not. So for individuals trading on a part-time basis or at the weekend, they will not be trading for tax purposes. They will be realising capital gains and losses. In relation to capital gains or losses, it's the pooling rules by which you calculate your gain or loss that you have to be most concerned about. Capital gains are taxed at 20%, and losses can be carried forward for up to 4 years. Now, the taxation of non-domiciled individuals is probably the most contentious area probably the most contentious tax issue in relation to cryptocurrency and individuals. And there are two aspects to this: inheritance tax and the capital gains tax non-domiciliary regime. The issue is where is cryptocurrency located for tax purposes, which basically means where is cryptocurrency located for private international law purposes. A non-domiciled individual is only subject to inheritance tax on their UK assets. They are not subject to inheritance tax on their non-UK assets. So a UK taxpayer would like to say that their cryptocurrency is a non-UK asset. There is very little in the way of authority on this. We have to go all the way back to 1901 to the case of IRC and Muller. And in that case, the House of Lords held that goodwill is situated where the business to which it attaches is situated. And by analogy to goodwill, cryptocurrency attaches to the place where the taxpayer holding it is tax resident. That is probably the best view. That means that for a UK tax resident individual directly holding a decentralized cryptocurrency like Bitcoin, that will be a UK tax asset, and they will be subject to inheritance tax if they pass away. The answer may be different for other cryptocurrencies. It will depend on the cryptocurrency. The way around this problem is to hold your cryptocurrency through an offshore company or trust, a properly structured offshore company or trust. So that is the way around that problem. A similar issue arises in relation to capital gains tax. Can a non-domiciled individual use the non-domiciliary capital gains tax regime to shield their capital gains from UK tax? The answer isn't clear. HMRC maintained that the deeming rules in the capital gains tax legislation don't apply. And so a decentralized cryptocurrency like Bitcoin is a UK asset. There is a decent argument that Bitcoin is a non-UK asset and that the deeming provisions do apply. I go into these arguments in a lot more detail in my book. The better view is probably that Bitcoin is a UK asset for the non-domiciliary capital gains tax regime, but the issue is not clear cut. Again, the solution to this problem is to hold cryptocurrency through a properly structured offshore company or trust. And finally, corporate structures for new crypto businesses. The best way to minimize tax is to set up a corporate structure in a low tax jurisdiction. Say, well, Gibraltar is a jurisdiction of choice. So setting up a corporate structure in Gibraltar is a good way of minimizing tax. The problem here is that you can't just set up a brass plate company in Gibraltar and have all your staff and yourself sitting in London and then claim that you are trading in Gibraltar. That is not going to work. You need substance around the business. It can't just be a brass plate in Gibraltar. You need a proper head office function, and you need your key programmers to be out in Gibraltar. I mean, that can be a challenge because a lot of programming talent is in London, but you need to come up with a clever way of structuring that business so you have sufficient substance in the low tax jurisdiction to make that structure defensible from an international tax point of view. So I've finished talking about crypto assets. Michael, I'm going to hand back to you. Do you want to tell us a little bit more about non-fungible tokens?
Ben, yes, certainly. And thank you very much for covering so many aspects in what you've just been talking about, covering gambling and trading, gains and losses, CGT, non-dom tax. And before I launch into non-fungible tokens, I can't help but feel a bit sorry for Mr. Ali, who relied on broker reports and lost £1 million. Well, I know it's often said about by lawyers that free legal advice is worth every penny you pay for it, but free broker reports is an even worse category than that. Cost you £1 million. Anyway, poor old Mr. Ali. Yes, non-fungible tokens. And as I said in introduction, this is a bit of an outlier, but I think nonetheless of interest. Non-fungible tokens are very much at the forefront of the news at the moment, whether one's looking at Sir Tim Berners-Lee creating an NFT of the original World Wide Web code and selling that for philanthropic purposes, whether one's looking at art at $69 million, whether one's looking at other luxury goods. You can't turn a page of a newspaper without non-fungible tokens being discussed. And I suppose it was when I was looking at the art world and recalled the introduction of the artist resale rights, introduced in this country in 2006 as a result of a 2001 European directive. The second element was the nature of non-fungible tokens. We're not going to go into that in any great detail in the present context, but it's sufficient to know that they are blockchain based and smart contracts can be incorporated as a matter of course within an NFT. And of course, smart contracts work on an if-then premise. So it's perfectly possible, and indeed, I think, has on more than one occasion been included. There's been an inclusion of a smart contract into an NFT on the basis that if the NFT is resold, then a stated percentage, and the originator of the work can state the percentage. So it may not be starting at 4%, which is the case with artists' resale rights. It could be, say, 10%. So you write in your smart contract. If the NFT is resold, then 10% of the resale price will automatically be transferred to the digital wallet of the author of the original work of art. And of course, the NFT can relate to a digital asset, but it can sit on top of a physical asset. So you can have a similar provision with regard quite easily to any work of art which is currently created. And the third element was to do the mental calculations of 4% on 69 million US dollars. I know it's a tapering scale and I know there's a cutoff point, but nonetheless, my mental arithmetic wasn't even up to the simple approach of how to calculate what the revenue stream would be for an artist, 5,000 days or whatever, but who sells the work of art for a substantial sum of money and then it's sold on, even if it's not sold on at anything like a profit. Obviously, you can have quite a revenue stream for artists by using smart contracts and by using the sort of if-then provision that I've just been discussing. And it did prompt me to wonder whether blockchain will be able to replace law, perhaps in this regard, perhaps in other regards. And we're into a sort of law is code and code is law discussion. But that's probably a discussion for another day, because whilst I've raised a question, it's not really my place at the moment to raise questions. It's the audience's place to raise questions. And I'm very pleased to say that we've had some good questions coming in from the audience. There's one which I'm not going to take, which was anticipating what you said about gambling, Ben. So I think that that question has been amply covered. But there's a further question. It picks up what you were talking about capital gains and losses. And it's a question from Lisa Short, focusing on capital gains tax. And obviously a tax, as you said, levied on the net gain in the value of any asset, here a crypto asset. Now, what Lisa was saying was the media seems to have a fixation. They love a bad story. They love someone catching a cold. And Lisa says, well, why focus on moment in time losses as viability, as volatility, when in fact, if you take a long-term view, certainly over a sensible accounting period like a year, you've got overall substantial gains. So I suppose it's a reaffirmation of the basis on which crypto assets are taxed from a capital gains perspective, but building on that, perhaps a commentary on the way in which the media portrays capital gains or capital losses on crypto assets.
Yeah, this is a tricky one. Why does the media choose to focus on moment in time losses? I guess it's the drama, if you like. It makes for a good news story. Yeah, it is more the hype around cryptocurrency. I think the media focus on the short term. Really, they're interested in getting the story. Their cryptocurrency is difficult to grasp from an intuitive point of view. It's easy to things like crypto, putting fear into people, talking about crypto scams, talking about the volatility of Bitcoin is far more newsworthy, or I wouldn't say it's newsworthy in the sense that it gets attention, but it's true that the bigger issues about how cryptocurrency might be used as a payment service, even the bigger issues about why people are investing in cryptocurrency, what is driving this, like it's not well publicized that financial planners are starting to recommend that clients hold part of their portfolio in cryptocurrency, or that is not something you've seen frequently in the media. It is it's in some of the financial press, but I guess it's just the way the media are geared. The media are focused on the short term. They are focused on getting people's attention, which means a dramatic news story, which means things like crypto scams, the fact that Bitcoin has fallen 40%, rather than the potential of this of cryptocurrency and blockchain technologies, and what the future might be.
And I think that's absolutely right, Ben. And I think you put your finger on it when you talked about the short-term approach that the media adopt, because they like an instantaneous soundbite. But of course, that instantaneous soundbite is highly artificial. It's only accurate if someone bought the day before, there'd been a downward spike in relation to the volatility, and then sold at the bottom of that spike. But most people, as you were saying when you in your introduction, was that there's now a gathering advice that holding crypto assets, holding cryptocurrency or other assets as part of a balanced portfolio, a relatively small percentage, is a good idea. So you hold that small percentage to take advantage of what Lisa was saying about the longer term overall percentage gains. And if that's what you focused on, and that's the sensible investment policy, the fact that there is substantial volatility and a downward spike on one day doesn't matter, as long as the broad movement of the graph is going in the right direction. And of course, what the media doesn't do is point out about the people who bought at the bottom of the spike, and then when the currency goes up by 30% in a day or even more, have a capital gain in those circumstances. I think that's right. We have another question, which stems from my comment on code is law and law is code. And we're asked to speak a little bit more about so-called smart contracts, which we're very happy to do, and how smart contracts should be taxed. Now, I think this is a very interesting question, because it's one of those questions which is very simple to pose and much more difficult to answer. Because when one looks at a smart contract is simply a line of code. So is there anything smart about a line of code? No, it's only what it does. Is it indeed a contract? Well, no. And yes, because it can form part of the contractual mechanism and operation. So, and I'm reminded of the founder of Ethereum, who he didn't coin the phrase smart contracts, but he certainly picked it up and ran with it. And in retrospect, he rather regretted that he used the term smart contracts, because it had a little bit too much of a popular appeal. And it didn't really tell you what is going on in a smart contract. So I suppose my view is that a smart contract per se is really back to being a piece of code, because it has an immutable consequence on the basis of an event happening, if then it will have a binding effect, however it's been written. But it's going to be a very sophisticated code which encapsulates an entire contract. And I think at the moment, smart contracts are being used more as adjuncts to smooth the way in terms of process. So if one's looking for, puts in a financial services context, you can execute a transaction, but in order to settle a transaction, you need to have not just the buyer and the seller, you need to have the broker, you need to have the custodian, you need to have the clearinghouse, etc. Now, if you can use smart contracts to make some of those complex elements of that process immutable, then it goes much more quickly, it goes much more effectively, and that helps everyone because it makes everything a lot cheaper. But the consequences of taxation in that context need, to my mind, to be looked at in a much broader context. Of course, if we reach a point of superintelligence, then you may be absolutely right, Andrew. We may be looking at taxing wholly automated contracts from cradle to grave. I don't think we're there yet. And I think that the tax implications are more in the area that I've just discussed rather than attaching to the contract itself. Ben, I don't know whether you have any views on what I've just been saying and indeed on the question.
Yeah, smart contracts, I would say, are generally taxed in a similar way to normal contracts. There is, I wouldn't say there's any special tax treatment for a smart contract. There was one other thing I was going to say about this question. I did make a comment when I was addressing non-domiciled individuals and taxation of non-domiciled individuals in relation to cryptocurrency. I referred to the deeming provisions in the capital gains tax legislation. In terms of the argument for and against whether Bitcoin is a UK or non-UK asset, it basically depends whether HMRC's view is that those deeming provisions are not code. If you're going to make an argument for the taxpayer, you would have to argue that those provisions are code. Code in the sense that they offer a prescription for deeming the situs of all assets, including cryptocurrency. I'm not sure whether that is what that question was getting at as well, but I just thought I'd reiterate. In relation to non-domiciled individuals, there is an argument. Yeah, there is an argument each way. It depends on your view of whether the capital gains tax deeming provisions are code or not.
Absolutely, and I think jurisdiction in this context is almost a topic in its own right for an entire webinar, because we have a developing tension between the jurisdictional centralized approach of national jurisdictions and the decentralized and therefore internationalized approach which underpins DLT, distributed ledger technology, and blockchain. And I think we're going to increasingly find this jurisdictional friction between national courts, particularly. I don't think it really goes into arbitration or otherwise, but national courts wishing, perhaps inspired by their regulators or otherwise, certainly by their legislature, wishing to exercise jurisdiction, and the need for quite long-reach jurisdiction, which we've already seen in some of the legislation in the US and the approach which has been adopted in Singapore, with the encouragement of the Market Authority of Singapore there. So you're absolutely right to raise the point about jurisdiction. I think we've probably unpacked that point as far as it's sensible to go. There's a lot more that can be said on that, but with time already at 5 o'clock, and we do try to keep these seminars and webinars strictly to time, because we know that you set aside an hour of your time, you have other things in the diary, you have emails to attend to, so we will finish at that point. We finish on time. It remains for me to thank you all very much indeed for joining us this afternoon. We hope that we've covered quite a bit of quite different aspects of cryptocurrency, cryptography, and taxation. We hope we've provided perhaps some answers to practical questions. We hope we've provided some food for thought and reflection. And thank you all very much indeed for joining us this afternoon. Have a good afternoon.